United States is on the brink of 1929 style depression. This is going to be by far the greatest crisis in the history of the United States. And it might seem like I'm exaggerating, but if you dig deep into it, you will find out that I'm not exaggerating at all. And after doing all of the research, I found out that it's a lot worse than I initially thought. So instead of actually trying to scare you, let me simply explain what exactly is happening, and you will judge by the end of the video, because this is some strange thing that is happening with the economy. So if you're ready, give this video a thumbs up and let's get right into it. To understand that, we have to understand how the economy works. The economy works in cycles. Overall, it grows. 100 years ago, the GDP of the United States was $19 billion. If we adjust that to today's numbers after inflation, that's $1 trillion. The GDP today is $30 trillion. Overall, the economy has grown 30 times. However, it wasn't a straight line growth. The economy grows through ups and downs. It goes through cycles. There has been recessions, crises, and many more. There has been even worse that dragged the economy down and down. However, every single time the economy got out of that crisis and continued to grow. So there is an economic cycle. The economy starts growing, interest rates are low, businesses invest and hire people. People make more money. When people have more money in their savings and in their pockets, they start spending money. That spending turns into an economic growth, and the economy keeps growing and growing and growing. In fact, at certain times, people feel like the economy will grow forever. Back in 2020 and 2021, everybody thought that the stock market will never collapse, and people threw every single penny they could into the market. However, at certain points, the economy peaks when inflation starts rising faster than in the economy. When the Fed realizes that inflation is growing faster than the economy, the Federal Reserve increases the interest rates in order to cool down the economy and control inflation. High interest rates leads to lower spending within the economy. When you spend less money, then businesses have to adjust, which means that they have to lower down their cost. And one of the ways they do that is by shrinking their workforce, which means that unemployment starts rising. People have less money in their pockets. They start spending less money, which means that the economy starts to slow down. At certain points, the economy even shrinks. That's what we call a recession. When the Fed realizes that the economy entered into a recession and inflation has cooled down, because inflation happens when people spend too much money. But now people are not spending money and the economy is in a recession. The Federal Reserve steps in, lower down interest rates, people start borrowing more money, businesses borrow money, hire more people, people have more money to spend, spending goes up, and the same cycle repeats over and over and over. There are two ways for the economy or the government to control the economic cycle. One is to lower down interest rate, but it does not always work. Other times, when the government realizes that we have lowered down interest rates to almost 0% and it's not working, then the government starts to borrow money in order to stimulate the economy. The government is this giant institution that has the ability to borrow a lot of money. So it borrows this money from investors. Investors are the people who are sitting with some extra money. These are the rich people. They realize the opportunity, they lend money to the government of the United States, the government takes that money and starts spending. That spending leads to more employment leads to people having more money spending means the economy starts to grow, and the economy gets out of the crisis. However, one man's debt is another man's asset. That is a very beautiful quote by Ray Dalio. When I'm loaning money to you, for example, to buy a house, you take my money and you go and get yourself a house. It is a debt for you. For the next 30 years, you have to pay me interest every single year because you borrowed that money from me. It's a debt for you, but it's an asset for me because based on that money, I will be receiving money from you since you have taken that money from me and the interest. So 2008 financial crisis happens and the government does what it always does. It lowers down interest rates, and it seems like it's not helping to grow the economy. It's not helping to help the economy to get out of the recession, especially when the United States is looking at the rest of the world, countries like China that are growing tremendously. So they feel this urge to act immediately and save the economy as fast as possible before it turns into another Great Depression of 1929. The government starts borrowing money and spending money in order to help the economy, and it doesn't help either. So the government does the unthinkable. Here's how the government borrows money. On one side, you have the government of the United States, and it wants to borrow money from investors. People on the other side who have a lot of extra money, these are the rich people, they want to make a return on their money. The government issues a piece of paper called a government bond, and this piece of paper is literally the debt. The investor buys it, the money goes into the pockets of the government. If it's a 2-year government bond with 5% interest rate, the government will pay the investor 5% on that $1,000, and 2 years from now will return that money back to the investor, the exact same $1,000. Now the question is that who determines at what interest rate the government will borrow that money? The answer is demand and supply. That's how capitalism works. The more people would want to buy government bonds of the United States, the lower will be the interest rates. The less people would want to loan their money to the government of the United States, the higher the interest rates will be risen by the government of the United States to attract those people to invest in the United States debt. But because the US government is the safest investment that you can possibly make, investors always demand an interest rate that is slightly higher than inflation. You know that lending your money to the government of the US is very safe, but you still want to make a certain rate of return. If inflation is 2% and you are making 2% on your money, then you are not making any kind of money or whatsoever. Because even though that you made an extra 2%, inflation has risen by 2%, you essentially made no money at all. It's much better for you and buy some kind of asset that rises together with interest rates or with inflation, like gold, for example. Which is why the government always has to provide you with an interest rate that is slightly above inflation, which is 1 to 2% higher than inflation. So if inflation is 4%, you expect from the government 6%. If inflation is 2%, you expect from the government 4%. If inflation is 10%, then probably you expect much more than that. So 2008 financial crisis happens, and the United States government is trying to borrow money from investors in order to stimulate the economy for growth. But these investors are not buying it. And all the money that the government over here tried to raise from investors did not help to fix the problem and get the economy out of the recession. So what do you think the government does? The government turns into the Federal Reserve in order to come up with a new terminology and a new method to save the economy, and they called it quantitative easing. Quantitative easing is the ability of the Fed to print money and directly buy government bonds in the open market. So if these investors are not willing to buy these government bonds, then the chairman of the Fed or the Federal Reserve is printing money and buying these government bonds. And the government of the United States will be left with all of those trillions of dollars in their pockets to invest it back into the economy to stimulate the economy to grow. But let's get back to the question, who determines the rates on these government bonds? If it's being determined by the supply and demand in the market, and suddenly you have artificial demand for the government bonds of the United States, interest rates would go down. In fact, if you look at the balance sheet of the Fed, you realize that pre-2008, there was not massive quantitative easing. In fact, you cannot even find the data for the balance sheet of the Fed prior to 2008, because the balance sheet of the Fed was not filled with treasury bills. To a certain extent, the Federal Reserve would buy them in order to stabilize the market, but it was around $700 to $800 billion for decades. The Federal Reserve was created back in 1913, and until 2008, the Federal Reserve only printed around $700 billion just to stabilize the economy. In fact, that money wasn't even printed, it was simply created in order to meet the demand of the market. And then suddenly in 2008, you see a huge surge in the balance sheet of the Fed, and the supply of money triples in a matter of a year. And it was created in order to buy these government bonds to provide the government with the money to get the economy out of the recession, since Lowering down interest rates did not help. Raising money from investors did not help. And that's what created the debt problem that the government is facing right now. The government has to refinance $30 trillion of debt. The total government debt is $37 trillion. $7 trillion of that is held by the intragovernmental agencies, and $30 trillion is being held by the public. And refinancing the debt is very simple to you refinancing your house, for example. When the time comes for the government to pay off the debt, and the government does not have money to pay that debt, let's say it's a 2-year government bond, and now 2 years has passed, and you have to pay these investors back $100,000. You don't have the money. You issue a new government bond, and you sell it to a new investor. You take that money from the new investor, and you pay the old investor the $100,000. But it's not $100,000 in this case, but rather $30 trillion that must be refinanced by the government of the United States. It wouldn't be a problem until you realize that the government is running a $2 trillion deficit, which means that $30 trillion of government bonds will get into the market and must be refinanced and sold to investors. And because the interest rates of these bonds are being determined by the supply and demand in the market, if there is not enough strong demand for these $30 trillion in the market, then investors over here will demand a higher interest rate, or the government will have to offer them a higher interest rate to sell this $30 trillion back into the market to these investors. And the worst problem is that it does not stop over here. It is increasing by $2 trillion annually. So $30 trillion plus $2 trillion of treasury bills will be thrown into the market to sell to those investors. The question is that, is there enough demand from the investors to buy these government bonds? Well, recent auctions in the open market shows that investors aren't willing to buy that many government bonds from the government. And that means that if investors are not going to buy them, who do you think is going to buy them? We will go back to the exact same problem that we had in 2008, when the Federal Reserve will artificially lower down interest rates or will create artificial demand for government bonds by printing massive amounts of money. They have done it back in 2012, and they have done it massively in 2020, and it seems like this time is not going to be different. Now, since you understand how economic cycles works and you understand the debt problem of the United States, now let's take these two terminologies or these two concepts and understand at which stage the US government is right now and what measures the government can take to save the economy. So if you look at the current economic cycle, in 2022, the economy reached its peak. That's when inflation was growing much faster than the GDP or the economy. The Fed intervened, it hiked the interest rates to slow down inflation, and the economy began to tank. In 2022, remember how many companies started going out of business? Since then, unemployment is slightly rising because businesses are spending less money and they have to cut costs. That means people will be fired from their jobs, people will have less money in their pockets, and less spending will be in the economy. And since then, everybody is expecting a recession because that is the natural economic cycle that everybody would believe. However, recessions are not scary at all. So what if we are going to have a recession? When we are going to have a recession, we'll simply do the exact same thing we have done over and over and over, and it will simply be an economic cycle. But here's where it gets really, really tricky. Because the government is going through a debt problem, it means that if we lower down interest rates right now, that is going to lead to higher inflation because the government has to refinance $30 trillion of debt and also has to create another $2 trillion of debt. And because there is no strong enough from investors to buy these trillions of dollars of government bonds, the Federal Reserve will have to step in to buy them, and that needs high inflation. And if inflation is rising, then investors are expecting higher returns. Remember, the bond market or the bond rates are being determined by the demand and supply. If investors believe that inflation are going to be 3% or 4%, they will always demand at least 2% higher than inflation rate in order to make sure that they're making any kind of decent returns out of their investments by loaning their money to the government of the United States. So let's assume that for every percentage drop that the Federal Reserve is going to lower down interest rates, that's going to cause inflation, the treasury bills are going to increase by a single percentage. It is a bit more complicated than that, but this is a pretty fair assumption that we can make at this point. Looking at the 10-year Treasury bills right now, they're being traded at a rate of 4.5%, and they have been rising since 2020. So because the debt or the public debt is $30 trillion right now, a single percentage growth in the debt means another $300 billion by the government to pay interest payments to the people who are holding the debt of the United States. And if we are in a recession and we have to lower down interest rates from about 4.5% right now by 3 percentage points, that means 1.5%. That means that investors would expect, or the yields on the treasury bills will rise by another 3%, from 4.5% to 3%. If a single percentage increase in the treasury bills means an extra $300 billion it will cost the government, an extra 3% increase will cost the government more than $900 billion. And if you also account the fact that the government is already paying $1 trillion in interest payment this year because of the amount of debt, that means $2 trillion of debt payments just this year alone. The government's revenue this year is going to be $5 trillion. $2 trillion of that means that it is going to go into interest payments. And how much the government is spending without this extra $1 trillion? $7 trillion. Which means that the government's spending will increase by another $1 trillion. And where you will take that extra $1 trillion? You will issue more treasury bills to the market to sell them to investors. Now, again, let's go back to the fundamental basic understanding of economics. Supply and demand determines everything. If you already have weak demand for the treasury bills that you have in the market right now, and you bring another $1 trillion of treasury bills into the market, what that is going to do to the rates of treasuries? It will increase the treasury yields, which means that your total interest payments will rise faster, which will force you to create more treasury bills. And it's a never-ending cycle that can bankrupt the economy because it is going to continue raising the treasury bills, which will force the government to issue more treasury bills, which will further increase the yields on the treasury bills, and until the government will simply get out of business. And this is the scenario that you don't want to get yourself into. However, there is a second option to solve this problem. And that option is that you are going to cut a lot of spending and you're going to increase taxes. But that means that the economy is not going to grow. So imagine the economy gets into a recession. And like every single time we lower down interest rate and the government spends money to stimulate the growth, we are going to do the absolute opposite. We are going to keep the interest rates high. We are going to cut spending and we are going to increase taxes. Will that lead to more economic growth? Of course not. It is going to lead to the absolute opposite. But this is the only solution, or the only feasible solution that could possibly happen. The government spends $7 trillion and it earns $5 trillion. So if we increase taxes and the government revenue will grow to $6 trillion and we cut spending from $7 trillion to $6 trillion, we will be able to balance the budget. And when the economy is not growing because you have very high interest rates, you are in a recession and the government is not spending, instead it's actually cutting spending, that will lead to a long recession that could potentially last for a couple of years. And if a recession lasts for more than 3 years, that's what we call a depression. And that will be exactly what happened in 1929. It will be slightly for different reasons, because in 1929, there was no a debt crisis like we have it today. But the debt problem right now is preventing the government or the economy from lowering down interest rates and increasing massively government spending. Will the government take this approach? Well, according to Ray Dalio, that is like 5%. However, there is another solution, and this solution is most likely. And according to Ray Dalio, the United States is not the first country that came across such a problem. In fact, there are many empires across the history that came across such a problem, and all of them unanimously, every single time, took the decision that I'm about to share with you, which is the real problem, something that you should really worry about. Let's go back to how the government is raising money. When the government has to refinance the $30 trillion, And it also has another $2 trillion of deficit, and all of that will be dumped into the open market to sell them to investors. And there is no enough demand from the investors. Federal Reserve will step in and will buy all of these government bonds. What exactly the Federal Reserve is going to take that money to buy these government bonds? That is the question you have to ask yourself. When the Fed buys a government bond, it is printing money to buy it. But when an investor is going to buy the government bonds, it's not printing money because investors cannot possibly print money. Investors use their own money to buy that bond. But when the Federal Reserve buys the bond, then the Fed prints the money in order to buy that bond, which is going to massively increase the money supply within the economy. If we increase massively the money supply of the dollar in the market, what that will do to the value of the dollar? The value of the dollar will instantly go down, which is going to cause massive inflation in the market. And now imagine for a moment, look at all these investors who have been buying US government bonds for years. In fact, they have purchased like $30 trillion of government bonds. And suddenly they realize that their government bonds have been devalued by 50% or 40%. Do you think they feel great about that? They have worked super hard. They have made money. Now, wait a second. Let's just change the entire frame. Let's say you are the person who lent his money to the government of the United States. Let's say you made $5 million and you took your $5 million and you bought US government bonds and you lent it to the US government because you trust the government of the United States. Now, the government put itself in a position where it has no other option but to use quantitative easing. And the government prints so much money and devalues your dollars, devalues your treasury bills. Do you feel great about it that you instantly became poorer by loaning your money to the US government? Will you trust the government of the United States again after it does something like that? Most likely not. And that is what it means that investors can lose confidence in the United States government. And if they do that, they might even lose the confidence in the dollar, which can prevent the dollar from being the global reserve currency. And that is a real problem. Will the dollar after that stop being the global reserve currency? Well, I don't know. Is there a probability? Yes. But the massive inflation out of that is 100% probability that is going to happen because we are literally headed into that. Do you really believe that anybody in Washington is going to raise taxes and is going to cut spending? And when I say cut spending, it means cutting military spending, cutting Social Security, cutting Medicare. I don't think anybody will be elected into office if they come out tomorrow and say that when I get elected, I will first of all cut your Social Security, I will cut your Medicare, I will cut the military. In fact, I will also raise taxes. So nobody will come into power promising such things. So this is the most likely scenario that is going to happen. When you have massive inflation, two things instantly happen. First of all, asset prices have to adjust. If you have your house, the price of your house has to adjust to the new supply of money in the market. So if we have devalued the dollar by 50%, and your house costs $100,000, now its price automatically will cost $200,000. If your stocks if your stocks in the stock market are valued at $1 million, instantly they will be valued $2 million, and so on and so forth. The price of gold will also have to adjust to reflect the new reality, which means that the wealth inequality is going to rise again since rich people have a lot of wealth, which means they have a lot of assets, while the vast majority of people have a fixed income. Now, let's assume that you're making $100,000. Will your income be adjusted to the new inflation? Maybe to a certain extent. But if the dollar is devalued by 50%, do you think your income will rise by 50%? Most likely it is not going to, which is why the people who are going to suffer the most out of this are going to be the people who are on a fixed income, because their incomes won't be adjusted to the new massive inflation like it always happens. Which is why the best way that somebody can protect himself against this crisis and even profit out of it is to make sure that you're invested in the right assets. Now you can go and educate yourself, learn on your own everything, and make sure that this is how you protect yourself based on everything that I have explained to you. Or you can check out the first link in the description of this video and you will find a step-by-step plan on how to do that. Thanks for watching, and I will see you in the next one.